Who do you turn to when you've got a broken company that badly needs fixing? For years, the answer was Lazard banker Jim Milstein. Jim worked on some of the largest restructuring assignments ever: Charter Communications, GM, Ford, and Chrysler, Delphi, WorldCom, and Budget Rent-A-Car. Then in 2009, he got a call from Treasury Secretary Tim Geithner to work on his biggest assignment ever, AIG. Last month, Jim finished his term as America's chief restructuring officer, and he is here on the Inside Track to tell us about it and why he's certain AIG will make money for the U.S. taxpayer. Jim, I want to get to the nitty-gritty of AIG in just a minute, but first, let me start with this. You've seen the wreckage of the financial crisis from inside what may have been the worst actor on Wall Street, AIG. Now that you're back on the outside, I want you to take a look at it all. Did we fix anything? Did we learn anything? Are we safer than we were before?
Well, I think with regard to AIG, for sure. When you look at the massive intervention the government did in the financial sector, what we did fundamentally, what the Federal Reserve, the Treasury Department, and the FDIC did fundamentally is help liquefy the balance sheets of these companies. They had relied heavily on short-term indebtedness, and they were very levered and thinly capitalized. And so the Fed and the FDIC and the Treasury what they largely did was provide short-term liquidity to these balance sheets so as to enable them to continue to function. With regard to AIG, we actually made a massive equity investment as well as trying to help stabilize the balance sheet. And the only way out was to actually do a resolution, to actually downsize the company, reduce its risks, and make it a smaller, easier to manage, easier to regulate company.
But it's not the only company that faced trouble. Let's talk about all the banks that had capital injections thanks to TARP, for example. Let's talk about all the other firms that were swallowed up by the likes of JP Morgan and Wells Fargo and Bank of America. Do those institutions make the world a safer place than they were before?
Well, I think the jury's out on that. I mean, I think what the...
How about your jury? What do you think?
What I think is that we had a major crisis, and in a crisis, the first order of business is to stabilize the system. Mm-hmm. We've done that. But when you look at what we did to stabilize the system, we actually made some of these institutions who were then deemed too big to fail, actually bigger.
Too bigger to fail now.
And now they're bigger. And there's a part because JP Morgan came to the rescue of Bear and WAMU, and because B of A came to the rescue of Countrywide and Merrill, and because Wells came to the rescue of Wachovia. So it was, in order to stabilize those failing firms, you had to put them with a stronger partner. The net result of that is, today, we have institutions that are even bigger than they were when the crisis started in 2008. Now, Dodd-Frank is a scheme, a regulatory and a legislative scheme, to try to bring those two big institutions to fail under control.
Will it work?
I think the jury's out. You've got 436 rulemaking procedures underway by 7 different regulatory agencies, all supervised by the Federal Stability Oversight Council, chaired by the Secretary of Treasury. It's a massive coordination task to increase the capital requirements, the liquidity requirements, to reduce the counterparty exposure risks that these firms carry, and we'll see.
But what everybody wants to know, Jim, is this. You've been on the inside, you restructured AIG, you know what's involved, and you know, or you have a good idea. You're not some economist, right? You're not some guy on the outside. You're not looking from the outside in. You're looking from the inside out. You're a restructuring guy. 10 years from now, 12 years from now, 5 years from now, maybe. Are you worried that you're going to get the call again to work on the restructuring of, who knows, Citigroup, Bank of America, JP Morgan, Wells Fargo? I could name any too big to fail institution.
Look, the Congress, in its infinite wisdom, determined that the right approach here is to try to regulate these institutions in a way so as to reduce their risks.
But can they be regulated?
I think the first question is, can they be managed? Are these institutions so large that they're really beyond the competence of a small board of directors and a small group of senior managers to actually embrace the risks? Well, I think the verdict on that, looking back to 2008, when these institutions were highly levered, deeply reliant on short-term debt, very profitable, but highly levered and highly reliant on short-term debt and with a very thin layer of capital. I think the verdict from that period is very difficult to manage. Now, everybody has learned from this crisis, and the risk management practices are definitely improving at all of these institutions, and the regulators have definitely had a wake-up call that you can't look the other way, you can't trust the management to get it right on their own, that they need somebody looking over their shoulders, at least asking good questions.
Jim, again, looking back, if there's one thing we could have done during the financial crisis that would be paying dividends right now, what would it have been?
Well, I think, look, the guys who, I think Chairman Bernanke, Treasury Secretary Paulson, President of the Federal Reserve Geithner did heroic work in the middle of a storm. When Congress finally authorized TARP and gave the Treasury Department more tools to work with to try to deal with the crisis at hand, the determination was made eventually to put equity into the banking sector on the view that that would help restore confidence in all creditors of all of these institutions. The government was sitting behind them in equity. But we put the most passive form of equity into these. We took really no control rights, no management control rights, and in part that reflected the ideological bias of the American capitalism.
Dump the CEOs, dump the boards?
Well, look, if you look at AIG, what we did with AIG, we did exactly that. We said, look, we're going to put money in, but the board's got to go, the management's got to go. And I think, frankly, the hostility towards TARP would have been much less had the government, in fact, extracted management change as a byproduct of having to come to the rescue of these institutions. I mean, there's no question but that there was a massive management failure in the American financial system, frankly, in the financial system worldwide. Far more risk was taken on than these people adequately really understood. And if the government had to come to its rescue, I think the public feels this, if the government had to come to its rescue, there should have been a price to be paid.
Looking at AIG, I know you're so outraged, I guess, that TARP Inspector Neil Borofsky questions whether AIG is going to make money. Why are you certain that it will make money for the U.S. taxpayer?
Listen, I'm not outraged that he's doing his job. I thought, he asked good questions, but he also expressed, I think, greater skepticism than was warranted.
So why should we be confident?
Okay, we should be confident because the Federal Reserve's credit facility has already been paid off. The Treasury Department has converted its preferred stock into equity. That equity is now trading. That implies a $15 billion profit to the Treasury Department. The Federal Reserve's positions in Maiden Lane 2 and 3, the off-balance sheet vehicles that they funded to help take toxic securities off the balance sheet of the company.
It's working, in short.
It's working.
How about the guy in charge, Bob Ben-Moshe? He's ill, and we all wish him well, but is he the right guy to be running AIG?
Look, Bob's been a great leader at a very difficult time in the history of this company. This company was flat on its back. It was the poster child for all that was wrong in the minds of the public with the bailouts. And Bob took this organization, got them standing on their feet and marching forward again.
All right, Jim, great to have you here. Jim Milstein, the former Chief Restructuring Officer for the U.S. Treasury. He turned around AIG.